What happens if the market crashes right after you retire? I'm Nick Yeomans, certified financial planner and retirement coach. And today we're going to break down a lot of this information to help you make really important decisions. You've worked 35 years. You're excited. Friday's coming, and it'll be the last time you're clocking out. We retire on a Friday. We enjoy our weekend. We celebrate. We look forward to Monday. What's going to happen Monday? The market crashes 30%. What do you do next? Do you call the boss and beg for the job back? Or do you proceed as normal? What does it look like? That can be an unnerving thing to think about. You retired. You're ready for this new adventure, the new phase of life, but the market is not cooperating. So let's talk about that. Let's talk about what do you do when the markets don't cooperate, but you really want that next step, that next journey. According to Charles Schwab and Co., they said one of the biggest risks that no one's really talking about right now is the sequence of return risk. And I know that's alphabet soup kind of language, but really there are three risks when we're investing and we're thinking about living on our money that we have to address. There's two of these risks you can control, you can do something about. The first is company risk. Company risk is when we're investing in our portfolios in specific companies. And this is not a list for or against any company, but, there's great companies out there like Apple and, Microsoft. And here in local Atlanta area, you've got Home Depot, Coca-Cola, Delta, great companies. Not advice, but these are good companies. Anything could happen at any company. One CEO or C-level executive does one bad thing. All of a sudden, we're not drinking aspartame or high fructose corn syrup. Well, sorry, Coke, might want to pivot. Maybe all of a sudden, American Airlines is trying to encroach on Delta Airlines turf. They're taking up some market share. I don't know, but you get the picture. What do we do? If part of our portfolio is in an individual single security, we have single security or single company risk. That's why owning a broad index like ETFs, a mutual fund that could have hundreds or thousands of holdings in it, or owning even a bigger basket of stocks can help us diversify single stock risk. Where we oftentimes see single stock risk today is early investors into Apple or Nvidia, or you work for a company that maybe went public, and with that, you got a lot of company stock. So diversifying away from that single company risk is something that you can control and could help mitigate that Monday where the market falls 30%. Then there's the second risk that we can control, and that's sector risk. To be diversified, it's not just owning Home Depot and Lowe's and maybe Ace Hardware. That is one sector, okay? It's not owning Coca-Cola and Pepsi. Well, while we did diversify company risk, we're in the same sector. Bank of America, Wells Fargo, Truist, again, same thing. So we can diversify against sector risk, and that's simply owning companies from a lot of different sectors: consumer durables, banking and finance, maybe energy, etc. No recommendations here. It's just this concept that we can further diversify to protect ourselves from that dreaded Monday event. Then there's the risk that we cannot control. And that risk is not one that's talked about often enough, but let me tell you something. It's like a thief in the night. It's dangerous, and it's coming. And that's called sequence of return risk. Sequence of return risk is this risk that basically says you and I cannot control. Is this going to be a positive year? Is this going to be a negative year? Nobody knows. The experts, 50% of them are wrong. And everyone who gets it right, they really didn't know they were right. It wasn't until December 31st that they found out they were right about this year in the markets. So sequence of return risk says that you don't know and I don't know if this is going to be a positive year, if next year is going to be a positive year, so on and so forth. The danger here is that you might have the best investment in the world, but if the market collapses tomorrow because of COVID, the Great Recession in 2008, Y2K, the biggest nothing that never happened, you and I can't control what happens next. We can have great investments, but that's simply a market sell-off. And that could greatly impact you as you go into retirement and you're anticipating taking withdrawals. So what do? How do you protect yourself? That's why you're here, right? That's why I'm here. Let's talk. Sequence of return risks. Here's what we need to understand so we can defend ourselves appropriately. I could have the same investment for two different people, but based on when we invested and when we start taking withdrawals, or when we change investments, their experience into maybe a really quality, high-rated company could be very different. You could have the XYZ fund, you and your neighbor, and one of you invested just 1 year different from each other. And that investment could have averaged, 10%, but that doesn't mean you made 10% on your money. You see, if you invested in a up year and your next door neighbor, they invested in a down year, fast forward 10 years later, your actual results in that very investment that may have averaged 10% would be different simply because of when you invested in it. And that is really the core of sequence of return risk. You can't control what happens in any given year. So what do you do to protect yourself? Really, at the end of the day, that's what this is about. Something my father taught me when I first got in the industry. He said, son, things should be easy enough to understand, but sophisticated enough to work easy. If I could talk, sophisticated. If I was to look at a lot of people's portfolios, they might have 3 different accounts with 3 different custodians, but they all look the same. Most of the money is invested in the same kind of companies or same kind of funds or same kind of indexes. There's really no diversification outside of having it in 3 different locations. So what we want to talk about is really our framing or our mindset about how we divide our money. One of the things I think the most successful retirees have been able to do to protect themselves against sequence of return risk is having a now portfolio. A now portfolio says, no matter what's going on in the world around me today, I can depend on this for the next 3 to 5 years. A now portfolio, the number one objective, don't lose money. Can't say that's guaranteed, but that's the objective. Be dependable, be predictable, go through really hard times, and you're still okay. You can sleep well at night because you have a distribution that's going into your bank account like a paycheck each and every month. That's a now portfolio. That should be invested very differently than a portfolio that's designed to keep up with taxes and inflation where we want long-term growth. Then there is the later portfolio. This is a portfolio you won't touch for at least maybe 5 years, 7 years, depending on how long your now portfolio lasts. This portfolio has a little bit more risks, and if we have a sequence of return event, it's got a little extra time to recover because it's not pure growth and aggressiveness and lots of volatility. We don't want to depend on that. You see, the number one objective of that later portfolio is over time, take profit, take dividends and gains and interest, and refill the now portfolio. So you have, for the rest of your life, a now portfolio you can depend on. So that later portfolio, super important. But, I said 3 portfolios. The last one's the future portfolio. We, over the last 100 years, have been given an incredible gift. 30 extra years of longevity, 30 extra years of life expectancy. Our money has to last at least as long as we do. So we have to grow it. Even in retirement, we have to have some money that's going to keep up with our healthcare cost, that's going to keep up with inflation, the cost of eggs, and it's going to keep up with taxes. I might be a little biased, but I think taxes in the future are going to be higher. So we have to keep up with taxes, inflation, healthcare cost, having a future portfolio that we're not going to touch for a very long time. That's just smart. And then having a system in place that helps us not just make money, but keep it. It's not what you make, it's what you keep. So the mechanism of that future money is to continue to feed the later portfolio. Now, some in our industry might call that a buckets of money approach. I don't know. I call it a successful retiree approach. We've worked with hundreds and hundreds and hundreds of retirees, And what we can say is this system works, and it's one of the best things that we could do to help somebody successfully navigate retiring on a Friday and Monday waking up, even with a market crash, and feeling pretty good, feeling confident. They've done the right thing to protect themselves for the next 3 to 5 years. Hopefully you found today's episode helpful. If that's you, you're considering retiring on that Friday and looking forward to a good Monday, but you have questions, feel free to hit us up at connect@yourretirementcoach.com. We'd love to be a resource for you, maybe point you in the right direction or answer some of your questions. We have another great channel that's more conversational, and as a matter of fact, we dig a little bit deeper into some of this content. Check us out at Coffee with Your Retirement Coach. We have a lot of fun over there. We'd love to see you. Thanks for joining us today, and thanks for staying coachable.